Okay, let's unpack this. If you were just scanning the financial headlines right now, the mood feels, well, it feels deceptively calm. We're talking fresh, all-time records. The S&P 500 recently sailing past 6,900, the Dow at an unprecedented 48,700. And sentiment surveys, they're all clocking in at a very neat non-committal neutral. But our sources, especially when you dig into the deep institutional flow data, they're telling a very different story.
That's the whole mission today, right? We have to look past those celebratory index-level headlines. We need to deploy the kind of rigorous analytical framework a senior portfolio manager uses to really assess the structural fragility.
So the goal isn't just about where the market is today.
Not at all. It's about finding the true institutional positioning, the unseen liquidity gaps, and finding those critical correlation tripwires that really define the risk-reward landscape right now. The paradox, like you said, is real. Headline records coexisting with this profound underlying market anxiety.
It's the ultimate market whiplash. Euphoria on the surface, paranoia down in the plumbing. And that paradox brings us right to our first major point, this tale of two markets. We're seeing this dramatic divergence in the underlying breadth of the rally.
And it's more complex than a simple rotation. We're seeing a rally that is somehow both broad and very narrow.
Okay, so how does that work?
Well, on the broad side, the strength is undeniable. It's driven by that recent Fed rate cut. The Dow and the small-cap Russell 2000 are leading the charge. The Russell jumped, 1.2% in the last session. That signals capital is rotating into cyclicals, value stocks, the banking and industrial names that really benefit from cheaper funding.
But if that were the whole story, the Nasdaq would be right there with them. Instead, it's lagging. Slipped 0.3%.
Yeah.
And that weakness isn't everywhere, is it?
No, it's hyper-concentrated in the mega-cap tech and AI ecosystem. We're talking about Oracle, Nvidia, Micron Technology, all seeing real selling pressure.
And that concentrated selling in the leadership names, that's the vulnerability.
It is. If the rally's breadth is divergent like this, where the legacy economy gets a boost but the high-growth leaders start to contract, it suggests the top of the market is thinning out, even as the indexes hit new highs. Which is why we have to zoom in on the most granular data point we have, the institutional flows right at the closing bell.
Okay, so why? On a day where the market settles neutral, or maybe slightly up, why does a PM dedicate so much focus to that last 30 or 60 minutes of trading? What makes those closing flows so informative?
Because the late-day moves reveal conviction, or, more importantly, the complete lack of it. It shows you who's willing to hold risk overnight or over a weekend.
So what's the tell?
Well, if we see a modest uptick in the SPX and NDX price during that last hour, and it's paired with an increase in trading volume, that signals institutional accumulation. It means systematic funds are deploying inflows, or active managers are cautiously adding to positions. They want to carry that exposure.
And the opposite, if those solid intraday gains just start to melt away into the close-on high volume.
That's the classic signature of distribution. Aggressive profit-taking. Active risk reduction by the institutional cohort. And if you see distribution on a neutral day, it confirms that while the headlines look great, the smart money just lacks the conviction to sustain the rally. They're lightening up before Monday morning.
All right, let's shift from price flows to the market's, I guess, its psychological state, the volatility landscape. Right now, it looks like a scene of, frankly, utter complacency. The spot VIX is suppressed, settling at 14.85. And the really short-term fear gauges, they're just crushed. The VIX-1D, which tracks volatility just one day out, is down near 10.7.
It's the definition of short-term comfort. And if you look at the structure of it all, the VIX term structure remains firmly in contango.
Can you give a quick analogy for contango?
Sure. Think of it like the price of insurance. It's the normal, healthy state where you pay more for an options contract that covers risk 6 months from now than for a contract that covers you today. You're paying more for future, unknown risk.
So if the curve is in contango, what is the market telling us it's hedging against? What's the timeline?
It's telling us the immediate crisis, or perceived crisis, has passed. That sharp suppression in the very short-dated measures, the VX-1D and VIX-90, suggests that institutions aggressively unwound their hedges right after the Fed rate cut. They feel safe from any shock risk this week.
But the concern is further out.
Precisely. Look at the curve. You've got December 2025 at 12.92, but then January 2026 spikes to 15.61. February 2026 goes to 17.77. So they're highly complacent about the present, but they are still pricing in meaningful turbulence for Q1 2026. That's when you have major events, upcoming CPI reports, key jobs data. Things that could redefine the Fed's stance. They're hedging the future, not the present.
Okay, here's where it gets really interesting. Before we move on, what's the single most immediate red flag a portfolio manager should be watching for in this Folsing structure?
Oh, that's easy. The crucial alert would be any rapid flattening or, critically, a swift flip into backwardation.
When the front gets more expensive than the back.
Right. When near-term futures become more expensive, that is the unambiguous signal of active, urgent institutional hedging against an imminent shock. When that happens, it means they are scrambling for immediate protection no matter what the headlines say.
That urgency, or lack thereof, brings us to our next section. Following the institutional footprints. If the headline market is confusing, we track the smart money where they trade. And that often means the dark corners of the market. What's the dark pool activity telling us?
It's showing highly selective conviction. I mean, we saw heavy activity in large cap ETFs like VOO and mega caps like Google and Microsoft, hundreds of millions changing hands. That's pretty standard. But the real anomaly was Oracle.
Oracle, the same one that just sold off publicly and dragged on the Nasdaq.
Exactly. Oracle registered a massive $166.69 million in dark pool orders. This is a classic institutional accumulation signature. They're buying the weakness, but they're doing it off the lit exchanges to avoid moving the price against themselves and showing their hand. It implies at least one major player believes that public sell-off was overdone.
But how reliable is a signal like that right now, given the overall institutional caution we're seeing? Are they really signaling a turn, or are they just catching a falling knife because liquidity is so thin?
And that's the key risk. Our sources indicate a really clear split. Institutional investors are cautious, they're maintaining flat positions or even actively withdrawing from U.S. equities, and yet retail investors are showing persistent inflows. So when institutional conviction is targeted, like that one Oracle trade, but not broad, and the retail herd is running in, that divergence just amplifies any price gyration.
So if the pros are on the sidelines, any retail-driven momentum, up or down, is just going to find thin air and result in these huge, exaggerated moves.
That is the danger. It's a structurally fragile foundation. And this need to look past assumptions brings us to maybe the most technical risk we're facing, correlation breakdowns. When the market fragments like this, your traditional safety blankets just stop working. Relying on historical correlation for protection, it could be absolutely detrimental.
The moment your hedge fails, the drawdown is exponentially worse. Okay, let's get into the specifics. What are the 4 critical correlation breakdowns that quant models are flagging right now?
First, we've got intra-equity divergence. As we discussed, that rotation between the strong Dow and the weak Nasdaq means you can no longer assume large-cap stocks move together. A broad index hedge against a tech-heavy portfolio. That hedge might just fail completely.
So it demands more granular hedging. You can't just short the S&P 500 anymore.
You can't. You need sector-specific hedges. Second is the VIX-SPY correlation. Quant models have flagged a significant breakdown in the historical inverse relationship between the VIX and the S&P 500.
Which is the entire basis for most volatility hedging.
It is. We rely on volatility to spike when equities drop. If that relationship is failing, your traditional vol hedges are fundamentally flawed. You need immediate adjustment.
And the third breakdown, on commodities.
Commodity disparity, huge divergence. We're seeing energy, specifically natural gas, weakening, while industrial and precious metals show robust performance. Passive commodity exposure is a huge drag now.
And finally, the safe haven issue. This is one that really challenges basic portfolio theory.
The fourth breakdown is the safe haven reevaluation. We are seeing this unusual lockstep surge in U.S. equities and gold. Gold, a traditional safe haven, is showing an abnormal positive correlation with stocks. That drastically reduces its diversification power right when you might need it, and it's prompting some serious discussions about asset bubbles.
So to recap, index records, suppressed immediate vol, targeted institutional caution, and a loss of reliable hedges. Given that neutral sentiment, the focus has to shift entirely from fundamentals to market mechanics, the structural vulnerabilities. Which brings us to the ultimate tripwires, the mechanics of gamma.
That's where the professional money is absolutely focused. We're scrutinizing liquidity in real time. We're watching order book depth in the bellwether futures contracts, the ES, the NQ, the TY. Widening bid-ask spreads tell you dealers are less willing to intermediate risk, and we're monitoring any stress in the overnight repo market because funding is everything.
But the real game here is gamma exposure, or GEX. For listeners who don't track this daily, can you paint a picture of why this dealer hedging process creates these sudden air pockets in the market?
Certainly. So gamma exposure is all about how options dealers have to dynamically hedge their books. And if they're in a state of negative gamma, the mechanics force them into a self-reinforcing feedback loop. Think of it like this. You're on a small surfboard in turbulent water. If the market dips, the dealers are forced to sell the underlying asset, paddling frantically with the wave, which makes the price dip even faster. That forced selling is what creates those sudden, outsized air pockets. It's a primary driver of risk acceleration.
And conversely, when they're in positive gamma,
They're a massive dampener. They sell into rallies, they buy into dips, which reduces volatility and makes the market sticky around key strike prices. Portfolio managers meticulously map out the high open interest strikes, what we call the call walls for resistance, the put walls for support, and the crucial zero gamma level, or ZGL.
the ZGL, that's the inflection point.
It is the switch. The zero gamma level is the exact price point where market dynamics flip from being mean reverting and sticky to being trend following and accelerated because of that negative gamma feedback loop.
So this all boils down to an asymmetric risk-reward opportunity. It's less about a directional bet and more about positioning for a regime change in volatility or price mechanics.
Exactly. The current setup offers two extremely asymmetric scenarios.
Well,
First, that steep contango we talked about, the market complacency, presents an ideal asymmetric long volatility opportunity. A minor shock could rapidly flatten or invert that VIX curve. Betting against this level of complacency could have an outsized return.
and the second opportunity is the directional move based on that mechanical vulnerability.
The second is positioning for a push through a key gamma flip level. If that ZGL is breached on thin volume, late in the day, or overnight, the forced hedging from the switch to negative gamma could lead to a truly accelerated outsized move. The risk-reward is highly skewed because a small price move can trigger a cascade purely due to structural mechanics, not new fundamentals.
So to summarize the strategic posture that you, the listener, need to adopt. This market, with its record highs, narrow leadership, and broken correlations, demands active management. It demands reduced reliance on traditional diversification and a meticulous daily monitoring of the market's internal dynamics, flows, liquidity, and that ever-critical gamma exposure.
You have to move beyond broad brush index assumptions and focus on the microstructure. And given that the most dangerous move is always the one nobody sees coming, we have to question this calm. How might that extremely suppressed front-end volatility, that VIX-1D at 10.70 be masking some latent funding or liquidity issue? What systemic risks are now hidden by the market's comfortable assumption that the Fed's recent rate cut just solved everything? That is the question that defines prudent risk management right now.